Jeremy Grantham, the renowned investor and market predictor, finds himself at the forefront of a financial storm, questioning the stability of the US stock market. In an exclusive interview with David Rubenstein on Bloomberg Wealth, he shares his urgent insights and issues a stark warning about the future of the US stock market, with the ominous possibility of a recession looming on the horizon. Grantham's track record for predicting financial disasters is well documented, and his latest predictions have sent shockwaves through the financial world. In a market brimming with optimism and rosy projections, Grantham's perspective stands out as a cautionary tale. Welcome to Wealth Wiz, where we're here to sprinkle a little financial magic in your life. Get ready to embark on an exciting journey filled with financial wisdom and fantastic tips. Hit the subscribe button and let's dive into the treasure chest of knowledge together. If you're up for boosting your money smarts and making savvy decisions, you've just found your financial fairy godmother. From his vantage point, Jeremy Grantham suggests that the United States has been riding a significant bubble wave, especially in 2021, which he characterizes as one of the greatest bubbles. He explains that the current phase should be a deflationary period, during which the bubble gradually deflates. This deflation, according to Grantham, hinges on several factors, including the potential decline in corporate earnings, a decrease in profit margins, and the looming threat of an economic recession. Grantham goes a step further by forecasting that this recession could persist well into the following year, potentially accompanied by a decline in stock prices. His perspective implies that the effects of the bubble have not fully dissipated and that there might be continued economic and market challenges in the near future. As Grantham delves deeper into the discussion, he expresses skepticism about the Federal Reserve's ability to accurately predict and respond to recessions. He criticizes the Fed's track record, noting that it has consistently been off the mark in its predictions, particularly when it comes to identifying recessions following major financial bubbles. For almost 2 years, a chorus of voices on Wall Street, including big money investors and former Federal Reserve officials, has been warning that the United States might be heading for an economic slowdown, perhaps even a recession. The outlook was less than optimistic. However, a fascinating turn of events occurred. The job market in the US remained robust, and inflation began to subside due to the Federal Reserve's aggressive interest rate hikes. Some experts began to feel optimistic, believing that Jerome Powell, the head of the Federal Reserve, could engineer a gentle economic slowdown, akin to smoothly landing an aircraft. Even the Federal Reserve's own economists changed their tune. Initially, they anticipated a minor recession, but their perspective evolved over time and they no longer foresaw such an outcome. Yet Jeremy Grantham, the astute predictor, advises against heeding the optimist and the Federal Reserve's economist. He implies that the Fed has a history of being overly optimistic, taking credit for fueling economic bubbles while downplaying the deflationary impact when those bubbles burst. He waves a caution flag, warning investors of potential trouble ahead, even as others grow increasingly confident. It's akin to saying, let's be cautious. Things might not be as smooth as they appear. Grantham further acknowledges that he had reservations about the Federal Reserve's handling of inflation. However, he now believes that inflation control is somewhat beyond Powell's control. He anticipates that inflation may not return to the exceptionally low levels of the past decade, instead foreseeing a period of moderately higher inflation and, consequently, moderately higher interest rates. Grantham simplifies the relationship between interest rates and asset prices, explaining that low rates tend to drive up asset prices, while higher rates have the opposite effect of pushing asset prices down. He suggests that we are entering an era where interest rates will average higher than they did over the past decade. This observation implies that investors should prepare for a different economic landscape, potentially with implications for asset valuations and investment strategies. But wait, before we dive into the financial fun, a big shout out to all of you savvy subscribers out there. Your support fuels our financial fire, and we're super grateful for your awesome energy. If you haven't joined our money loving squad yet, don't be shy. Hit the subscribe button pronto. You'll instantly become a member of our growing community of financial enthusiasts, all in a quest to boost their financial mojo. Let's do this together. As Grantham reflects on his journey, he reveals that his firm, GMO, initially specialized in value management, with a track record of beating the benchmark for 9 consecutive years, boasting an average outperformance of 8 percentage points each year. This success attracted significant capital inflows. However, GMOs became widely known for predicting bubbles and recognizing market imbalances during the late 1990s, when they began writing quarterly letters. This period coincided with the infamous dot-com bubble of 1999. During this bubble, they adopted a contrarian stance, recognizing the unsustainability of market euphoria. However, their caution proved to be premature, leading to a challenging 2-year period as the bubble continued to inflate. Unfortunately, their contrarian approach resulted in several client departures. Even more intriguing, despite these contrarian positions, none of the clients who had pulled their investments during the dot-com bubble's collapse returned for the same product. Grantham attributes this to personal changes within client organizations, as well as the firm's ability to navigate the turbulent market conditions of 2000, 2001, and 2002 without incurring losses. The firm managed to achieve positive returns during these challenging years, further cementing its reputation for resilience. In Grantham's opinion, the desire to be part of a bubble is often driven by FOMO, the fear of missing out. When individuals see others around them profiting and getting rich during a bubble, it becomes supremely irritating, and they feel compelled to join in to avoid being left out. Grantham also touches upon the concept of inflection points, critical moments in a bubble's development when a significant number of people become bullish and stop thinking about fundamental factors. These inflection points, which occur relatively rarely, mark the periods when bubbles truly take off, becoming even more captivating. Jeremy Grantham's response to the question about why humans cannot resist participating in bubbles highlights the powerful role of human psychology and social dynamics. He explains that the desire to be part of a bubble is often driven by FOMO, also known as the fear of missing out. When people see others around them profiting and getting rich in a bubble, it becomes supremely irritating, and they feel compelled to join in to avoid being left out. Grantham also touched upon the concept of inflection points, which are critical moments in a bubble's development when a significant number of people become bullish and stop thinking about fundamental factors. These inflection points, which occur relatively rarely, are when bubbles truly take off and become the most captivating. In conclusion, Jeremy Grantham's cautionary advice to avoid the US stock market is rooted in a deep understanding of historical market dynamics, the Federal Reserve's past performance, and the powerful impact of human psychology. His candid insights, informed by his experiences navigating past financial crises, serves as a vital reminder to investors in a world often dominated by optimism and rosy projections. As the financial landscape continues to evolve, Grantham's perspective stands out as a beacon of prudence, urging investors to tread carefully in turbulent waters. Thanks for dropping by. If you enjoyed what you saw, show us some love with a like and subscribe to our channel so you don't miss any money-savvy videos. Don't keep this financial goodness to yourself. Share it with your friends and colleagues. Let's secure our financial future together.